The recent bout of profit booking has eased concerns surrounding valuations in the market. At the headline level, the benchmarks have corrected nearly 10% from their record high levels, while individual stocks have tumbled nearly 50% from recent peaks. Among these, shares of recently listed companies, especially from the digital space, have been the worst hit. FSN E-commerce Ventures, Nykaa, PB Fintech, the parent company of Policy Bazaar, Tega Industries, Tarson's Products, Aditya Birla Sun Life AMC, SJS Enterprises, Indigo Paints, Anand Rathi Wealth, and Glenmark Life Sciences hit their respective lows since listing on December 20. Further, 50% of the companies listed in the past 2 months are trading below their issue price, including RateGain Travel and Technologies, Star Health and Allied Insurance, Paytm, and Policy Bazaar. And analysts say the worst may not be over for some of them yet. G. Chokalingam, founder and chief investment officer at Economics Research, for instance, suggests investors should carefully analyze the business prospects of each of these companies before taking an investment decision.
I would not suggest retail investors rushing to buy the e-commerce companies which are listed recently. I want to make a very interesting, important insight. You have venture fund investing in equities. Normally, they are rewarded only the full cycle of venture fund is completed, which means they take a maximum risk in investing in new ventures, and only when the ventures become highly successful in terms of bottom line, they unlock gains from that. So what I observe here, most of the e-commerce companies listed, they are loss-making and substantially loss-making. Even some of them have not improved the top line also. So what I'm trying to tell you is that the venture capital cycle is not yet complete, but they rush to the market to list them at a substantial premium. And in the process, many retail investors are converted into a venture capitalist. And whereas most retail investors do not have adequate knowledge to evaluate. So therefore, one should avoid them. And unless you are confident of, with help of any research analyst, that within 2-3 years they turn around, will make a substantial profit to justify current valuation, you should not get into that. So which means 7 out of 10 are avoidable. One should not take a risk just because they have corrected. I believe most of them can correct at least another 20-30% from the current levels.
Gaurav Garg, head of research at Capital Via, echoes a similar sentiment and says that the current market sentiments have put almost all the IPOs on back foot, and we have seen muted listings on most of them. I think in the current market situation, most of the blue chip companies with strong balance sheets are available at decent valuations. Investors should look at buying them and can wait for a few quarters more to see the performance of recently listed companies. The so-called hurried decision to hit the market by new age companies followed a strong bull run and a gush of liquidity in the markets. According to an analysis by Kotak Mahindra Capital Company, the year 2021 saw the highest ever IPO volumes in the country, with the volume surging to $15.3 billion as against $4.2 billion in 2020. That means the street saw more IPOs in 2021 than in the past 3 years combined, both in the numbers of listing and the amount raised. However, despite the current volatility and steps by central bank to escalate the process of liquidity withdrawal, the IPO frenzy is set to continue next year. According to Kotak Mahindra Capital's estimate, $26 billion worth of issues are in the pipeline from resilient sectors such as new age tech, healthcare, consumer, realty, and specialty chemicals issues. While IPOs worth $15 billion have already been filed with the SEBI, issues worth $11 billion are likely to be filed near term by several high-quality companies across large caps and mid caps. That said, V. Jayashankar, whole-time director at the brokerage, had this to say. While 2021 was huge for IPOs, we expect 2022 to be another good year. Nevertheless, investors should be cautious and not assume all IPOs to hit the bullseye. On Wednesday, Metro Brands joined the bandwagon of companies staging weak debut as the shares listed at a 13% discount in a firm market. Against this backdrop, shares of newly listed companies will be on investor radar. That apart, stock-specific news flow, weekly F&O expiry, and general global trends will guide the markets.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.